This video is definitely going to upset a lot of people. Now, when you hear the saying, you can't outperform the market, how difficult it is to outperform the market, most people just assume that is stock picking, someone trying to pick a stock. But in actual fact, every single investment decision someone makes that is not investing in the market is planning on beating the market. And what I notice is when most humans are told you can get an average return of 15% if you invest in the Nasdaq. And honestly, most humans scoff at that because they do not understand how unbelievable a return that really is. They scoff at it and say, why would I do that when I can just invest in my own business and make my own money and do my own thing? Having control. They have the illusion of control and they view the stock market as risky. The stock might drop and they have some paper losses and they view that as risk. But they view setting up a business as not risky because they have control. They control the effort, but it doesn't mean they control the outcome, because the brutal reality of financial physics is going to hit them right in the face. And I'm going to break down in this video 4 romanticized businesses that people think are fantastic, great businesses, when really I'm going to leave them absolutely nowhere to hide. We're going to rip the floorboards up and expose the reality, the true reality of what most of these businesses are making compared to their competitor, which is the Nasdaq. And I also think another reason people scoff at a 15% return is many people confuse gambling and investing. They can't actually tell the difference between the two. And that's a huge problem, especially for people that are not educated on investing or any financial literacy. Let's jump into the first case study. E-commerce. So e-commerce is a popular one. Well, it was popular a couple of years ago, especially when interest rates were lower. The honest truth is, all these businesses that are selling gizmos, gadgets, and commodities, they only exist because debt is cheap. In fact, that's why most of these zombie companies exist in the first place. You ever watch Shark's Tank or Dragon's Den, and these people go on with this useless gadget and say, look, this is a useless gadget, but it's going to help people, do some menial task in the house. These businesses would not exist if debt was more expensive. Interest rates are going up. We are entering a higher interest rate environment, and these businesses are getting absolutely exposed for what they truly are. And e-commerce is definitely one of these. Look at this business, 1.5 million in revenue. See, this person's like, look, I'm making 1.5 million. Who needs the Nasdaq? Yeah, screw the Nasdaq. We're printing real money here. The fact is, they're absolutely not. They are making a true net margin of 8%. So reality is 120,000 is profit, because you've got to factor in their marketing costs, operating expenses, the cost of goods sold, logistic costs. They're a full hostage to a Chinese supply chain and container costs. And they do not even own their customer. They have to buy their revenue. They buy their revenue via marketing. Now, how much of the net margin is real free cash flow? Because this business is an absolute liquidity sinkhole. It requires constant increase in inventory. You have to constantly reinvest in the business. All that money's tied up. When entrepreneurs start a business with their own physical cash they've worked hard to save up, they think that cost of equity is free, but it's not. Their own money is not free. They think only debt is a cost, but it's not. They do not factor in their actual weighted cost of capital. Yeah? Because what if they invested that money in the market? They have to compare their returns on their business to what they would have got in the market. That's what the WACC really is, weighted average cost of capital. Their hurdle rate is 12.3%. This business owner isn't even making that on their net margin. But it gets worse because net margin doesn't pay for things. Cash pays for things. Free cash flow is only 50k. 50k of the actual real cash, because you've got to think of ad spend, increase in inventory, capex, buying warehouse scanners, laptops, Shopify builds, whatever it may be. Now, businesses do not run perfectly smoothly. Any business owner will tell you mistakes happen all the time. Things go wrong and businesses lose money. Now, what would actually happen in this business if it made a mistake, a logistic mistake, a shipping mistake, they filed the wrong paperwork and they paid massive tariffs, duties, or whatever it might be? They lost 10,000, unexpected payment. Now, a business owner thinks, well, we lost 10k, so we need to just make an extra 10k in revenue. Wrong. Completely wrong. It's not 10k off their revenue. It's 10k off of pure net cash, raw liquid cash. The business owner has to make 125,000 in new revenue just to rectify the 10,000 mistake. So they're having to run more advertisements, make sure those ads are running well. They have to pay their taxes, their software, just to make up the loss of that 10k unexpected mistake. And think of that over 10 years of a business, 10 mistakes over 10 years, which is conservative. How much is actually draining of their free cash flow? Huge amounts. Now, we're not even finished yet. I guess the net margin, the free cash flow is already paper thin. Now we have to factor in currency debasement. How does the business perform against a bar of gold? Yeah, so we have to factor in economic profit, massively in the negative. Negative 37,000 once you factor in true inflation. Yeah, but the business owner says this is I'm in control, so it's not as risky. Let's look at the gym. One of the most romanticized businesses is a gym. Everyone wants to open a gym. What's the gross revenue? This gym here, 750k. What's the net margin? 12%. Okay, how much of that actually is real free cash flow? 45,000. Debt repayments, maintenance capex. They need to buy new bikes, replace rigs, fix an AC unit. Yeah. Now, keep in mind, gyms are so expensive. 400 grand just to likely build it. Let's say they put in 200k of their own money, 200k in a loan. Their actual hurdle rate is 11.9%. That's the true hurdle rate. All that money is tied up in gym equipment when it could have obviously been in the market. What's their actual true net wealth creation? Negative 60,000. It's painful. What's more painful is gyms often do not have pricing power. So, and it's no switching cost for someone just to leave. The 10,000 mistake for the gym is horrible. If they make 10,000 mistake on a margin of 12%, the owner must generate 83,000 in brand new revenue. $158 per month per member. An owner must acquire 555 new monthly members or charge 46 members for an entire year just to bring their bank account balance back to zero. So a single broken AC unit effectively wipes out an entire quarter of the owner's net worth. The total addressable market is microscopic. Yeah, see, the global Mag 7 can charge customers globally. And a gym, there's no moat whatsoever. A franchise can open a brand new gym down the street and undercut their prices. Okay, here's the worst one, without question the worst. Hospitality, bakeries, cafes, restaurants. These absolutely have the worst ROIC on earth. It literally is the absolute worst. The actual asset that they sell is a perishable asset. It literally depreciates every day. It's food. If you don't eat it, you throw it in the trash. Let's be generous. 1.2 million in revenue. Huge operational friction for a 5% net margin. Welcome to hospitality. 60,000, 5%. How much of that is free cash flow? Probably about 30,000. Debt principal, paying back debts, maintenance capex, depreciation add back. Yeah, you're getting 30k. So just think about how much friction it is to generate that amount of money. To put $1.2 million through a register with 15 employees and thousands of customers just to get 30,000 in liquid cash. What's their weighted average cost of capital? 12.3% is the hurdle rate. Not even anywhere close to it. Not anywhere close. This is just where capital goes to die. So they've locked in 500k of fresh cash is tied up in ovens, tables, and infrastructure. With the same money into the Nasdaq would double every 4 or 5 years. True net wealth creation, negative $116,000. Because you need to factor in inflation. The commercial banks are printing away the money. Supply is increasing and they're losing wealth in real terms. It's so sad that if they held a bar of gold and stayed in bed, or even a treasury bill or a US bond, they would have created more net yield. What would happen if a $10,000 mistake with a miserable 5% net margin? It's a localized financial disaster for this cafe. It needs to generate $200,000 in brand new revenue to make up the $10,000 mistake. So $5 a coffee. The owner must acquire, bake, brew, serve and clean 40,000 individual transactions just to recover from one broken freezer. But yeah, these people, when you tell these people, you could invest in the market, they say nope, that's risky. That's risky. When they don't class this as risk, they have absolutely zero pricing power. Zero pricing power. Oh, and they're hostages to minimum wage workers. Yeah, it's a Saturday and the staff member says, I'm not coming in sick, I'm hungover. And the owner, the entrepreneur who's living the dream has to go in and work. And most of the time, they don't even pay themselves an hourly rate. They work for free or less than minimum wage. But they look like they're successful because there's 1.2 million in revenue flying through. The cafe looks busy. It looks unbelievable. It's a highly leveraged, hyper-taxed depreciation public utility. It's a public utility run by a private citizen. Horrifying. This one's also going to hurt a lot of people. Agencies, marketing agencies, creative agencies. Because you might think, okay, let's look at this because, hold on a minute, we don't have a high infrastructure cost. So surely this actually should be profitable. Now look at this, 1 million in revenue, but it's got an 18% net margin. This looks okay. This is exactly what makes the trap so bad. What is the actual free cash flow conversion? Okay, B2B, here's the biggest problem we have with B2B world. Large corporate clients do not pay up front. So you have absolutely no cash flow. These customers are paying 30, 60, 90 days. You have to sit and wait while paying all your staff members, and you're acting effectively as a zero interest bank. So 80,000 is the free cash flow after you increase in accounts receivable. That's the biggest problem with this. Yeah, these clients are just holding on to your money, and you're the float. Yeah, you're the victim. Waiting, please, sir, can I get my invoice paid? Have to beg for the money basically. For the work that you've done. So they have 80,000 in the bank, the rest is tied up in accounts receivable. Right, so there's massive key person risk in this, even though it's asset light. You've got to factor in the risk. So 18% is your hurdle rate. Because if any of these B2B clients just simply don't pay, the business can be eviscerated overnight. So again, when you run the actual illusion of 180,000 in nominal net profit, they have a market salary of 150k. So making a good salary, but what's the actual net wealth creation? It's negative. It's negative. Currency, money supply gets printed more money. They would be better off with a job. You don't need to. They could just get a job, 150k remote tech sales job, and the rest of it goes into the Nasdaq. They would be far better off than this strategy, because they're taking on all the anxiety, client churn, chasing invoices for no true wealth creation. And their $10,000 mistake, they have to replace it with 55k in revenue. Here's the biggest thing with agencies. Because they're very much they're in the sales industry, guess what they do? All the time, because they have absolutely no pricing power, absolutely none, they are forced to offer a discount. Now, in the world of arithmetic, they say, if I offer a 10 or 20% discount, I'm only losing 10%, 20%, right? Absolutely not. Absolutely not. So what happens is, let's say the price is 10k, they offer a 20,000, they offer a 20% discount. But they're on an 18% net margin. What happens? They're actually in the negative. They've lost money. So listen to this. By offering a 20% discount, the founder did not lose 20% of their profit. That's what they think in their head. They vaporized 111% of their profit. That's the math. Yeah. See, this video will annoy a lot of entrepreneurs and business owners. It shouldn't actually, because when you understand this, you actually become better, and you actually can fix a business very efficiently if you actually understand the brutal corporate finance, not the rubbish that an accountant tells them. An accountant just looks at the net profit and says, there's your net profit, and the owner feels broke because this is the reality. But what it's doing is this hurts their identity, because their identity is tied to the business, and that's a massive flaw. When we invest, we should have absolutely no emotion. Okay, if I'm investing in an individual company, I'm not attached to the stock. I don't care. I just look at the math. I just look at the finances and the numbers. That's all I care about. I don't have any emotional involvement in it. But a business, it does, because of sweat equity. The owners get hooked onto their business, attached to it. And that's what destroys them, because they sit in these businesses for 10 plus years, scraping by, when the business doesn't work out anyway, and they've lost 10 years of opportunity cost, where they could have just had the money, boom, in the Nasdaq. Institutional liquidity, prime liquidity, prime collateral. You can borrow against this at institutional rates. You cannot borrow against a marketing agency. Yeah, you can't phone up a Swiss bank and say, can you loan me against my my cafe, my gym, my e-com business? Honestly, this is the reality, the real reality. I mean, here's another one. What if the client doesn't pay at all? This happens all the time, especially like a small agency. They're just like, screw it, I'm not paying you, and they'll lose 20,000. What do they need to do? The client doesn't pay them back. They have to make 111,000 in brand new, fully paid top line revenue to make up the loss. You see why it's a treadmill? It's such a treadmill. It doesn't need to be, though. It doesn't need to be. I'm not offending people's businesses. I'm telling you, this is the reality. This is math. You want to fight the math, fight the math. You can't negotiate with it. It's just reality. Accept the business for what it is. If the owner actually said, okay, this is just this is a job that I have where I don't really have a boss. I mean, you kind of do have a boss. Your bosses are your clients. Your bosses are the IRS. Your bosses are customers. Your bosses are suppliers. You get the point. But fine, okay. That's fine. It's a job without a boss. Take the money and invest it into prime assets. Real assets that actually outperform the money supply, that outperform gold. high growth, aggressive ETFs, balanced portfolio. Unless you want to be a slave to a business. The reality is, the research shows most people who are employed and invest correctly are far more liquid rich than entrepreneurs that are trying to. Here's the reality. Entrepreneurship is actually, the true entrepreneurship is served for people that create something that goes from 0 to 1, the true innovators that are trying to push this civilization forward, right? So look at Elon Musk with SpaceX. He is creating rockets that can land. We can now reduce the cost of how many rockets we can send into space. That's true entrepreneurship, where you're making something that pushes civilization forward. Now, if you ask 99% of entrepreneurs, are you setting up this business to move civilization forward? I know for a fact what they're going to say. They're going to say, well, no, but it's so I can, make more money. It's so I can make more money and I don't need to answer to a boss. That's really the truth. When they're actually just setting up a commodity with no pricing power, no moat, no free cash flow, no true real wealth generation. So when you see a business, this will completely flip the way you look at it. Honestly, I'm at a point now where if someone just told me, if you were to just tell me the industry, the revenue, the number of employees, I already know in my head what the net margin will be, what the free cash flow will probably be. Unless I don't know what the debt is, I can already just instantly, my brain just goes, right, I can already tell if that business is running at a loss or if it's making profit, and just with just that information. Because entrepreneurs think their business is so unique, so their situation is so unique, and what they don't understand is there's about millions of other people on the same treadmill with the same problems. It's not unique. True entrepreneurship is honestly designed for the real innovators, the real civilization movers. That's really what it was for. And cheap interest rates, cheap debt creates all this hustle culture. That's where it all comes from. If the Fed just decided tomorrow, right, the base rate, the Fed fund rate is now going to be 8%, 10%, like Volcker era. Guess what's going to happen? A controlled demolition of the entire economy. These businesses, these gyms, these e-commerces, these bakeries, they are, we need them for society, right? But that's not really what pushes a country forward, really. I'm not trying to lecture you, right? You already know this. But if we set up 10 coffee shops and everyone has a coffee shop and we're all just passing the money around to each other, civilization wouldn't move forward. We need the stock market. We need these people, these engineers, these intelligent people that really want to make a difference, really want to invent new technology, and they set up a company and the IPO, because they have the stock market gives them an incentive to create. And then the IPO hits, like SpaceX, those people were all paid from the IPO. The stock market is serving its purpose. It's a voting machine. The companies, we are voting on that company. We are reducing their cost of capital. Anyway, I went off topic, but you get the point. 99% of entrepreneurs will never beat the Nasdaq, and this is going to anger a lot of people, but I don't care. This is the facts. This is reality. Don't fight me, fight the math.